Hey everyone, welcome to Beach Investing. I'm your host, Andrei Angelkovski. We're back with Jordan Weinberg. How are you, Jordan?
Good, thanks. You?
Good, thank you. Jordan is a chartered accountant specializing in real estate and small businesses. And what we're going to be talking to you today about is different methods, or the most common methods, to buying real estate in the United States. So we're hearing a lot of news lately that the U.S. market is heating up a bit now. It's picking up, it's recovering from that big recession that they had. So a lot of Canadians are going down south and picking up some great deals in the U.S. market. So what Jordan's going to talk to us about is some methods on how to go and buy in a more simple, I guess, layman's terms way.
Right. So there's any number of structures you could use to go purchase U.S. real estate. I'm just going to go over some of the most commonly used and the basic ones, just to take some of the edge off of what you would have to do if you did want to go buy U.S. real estate. So the first example I'll give is an individual person going and buying U.S. property. So what would happen in this case is, if I went down, let's say, to Florida to buy property, what I'd have to do from a compliance standpoint is I'd have to file a U.S. federal income tax return and report the income from the property. Of course, any income, there would be tax generated with that, and I'd have to pay it to the IRS. What then happens is on your Canadian return is you then recalculate the taxes as if you own the property from a Canadian perspective. As if it was in Canada, you do the tax return, and a Canadian tax picks up. Any U.S. tax you paid when you filed your U.S. return, you now get a foreign tax credit on the Canadian portion that applies against your Canadian taxes. So that's the most simplest thing. So basically, what you've done is you've doubled your reporting. You have to file a U.S. personal tax return and a Canadian personal tax return. Now, when it comes to the U.S., certain states you only have to file a federal return, but most states you have to file a federal return and a state return. So just keep that in mind. Under that method of buying real estate, on your own. Okay. The most common, one of the most common forms we see is a group of people getting together and they want to invest in U.S. real estate because maybe they want to buy multiple properties or it's expensive. So what happens in this case is they set up a Canadian partnership, and the Canadian partnership goes and buys U.S. property. In this case, what happens is everything when it's done in a partnership is done at the partnership level. So all your income is calculated at that partnership level. And the partnership that's in Canada has to file a U.S. partnership return. And then each of the individual partners have to file a U.S. federal return and potentially, like I said before, a state return. And they'll pick up their share of the income from the partnership on their personal return and pay their tax to the IRS. Now what happens is on the Canadian side is you'll have to do a Canadian partnership information return, and you'll get a T5013 like you do for any Canadian partnership, and you report that on your Canadian personal tax return. What happens is any tax that that's owing on your Canadian return is reduced by any tax you paid on your U.S. return. So you get that foreign tax credit again. Okay. So essentially what you've done is, imagine a person that buys a Canadian partnership that buys Canadian property. You have to report the Canadian partnership return and then report it on your personal tax return. You essentially mirrored that reporting in the United States. Okay. So basically, again, just like the personal example, is you've mirrored the reporting, and every individual has to file an American personal tax return. Okay. The last structure is a little bit different. It's a corporation purchasing U.S. real estate. So a Canadian corporation would have to file a U.S. corporate return and a Canadian corporate return, and then they can purchase the real estate, and they pay the corporate tax in the United States and get a tax credit they get a tax credit for any, when they recalculate their Canadian corporate taxes for any U.S. corporate tax they pay. The only advantage with this is that the shareholders don't need to file personal U.S. tax returns. So you can see the difference in the first two structures where you have to file personal tax returns, and a corporation you don't. However, be aware that from a tax rate perspective, the U.S. corporate rate is 35%. It's pretty high. And then there's the double tax of when you pull the money out of the corporation. Okay. In all these different common methods, it should be noted that these aren't efficient necessarily trust structures, or estate structures. So there is quite punitive estate taxes if you're over certain thresholds in the United States. So just keep that in mind, that you should talk to a professional before setting up your structure, especially if it's a group of investors. But those are the basic three different structures you see. And essentially, just to take some of the edge off of doing it, is you're just mirroring the reporting in the US and Canada, and any tax you pay in the US you'll get as a foreign tax credit here. That's the theme of it. So it's just a matter of just understanding that and knowing that there will be additional compliance costs and reporting costs.
But everyone's situation is different, so it's best to speak to a professional, an accountant preferably, to determine what method suits your personal circumstance, right?
Right, especially with anything cross-border, because then you get into two governments and there's border treaties. So, you should speak to somebody before going out and buying the property. Definitely will help cover you in case, just to make sure you're set up appropriately. But that being said, those three structures are not that scary that, you can't go out and do this stuff. But just something to keep in mind that, when you were in the United States, it's a different country, different tax rules. What you've been doing in Canada doesn't necessarily apply down there.
So it is more simple than people think it is, right? Or sometimes more complicated.
Right. It's more simple, but you've really ratcheted up the number of compliance items you have to do. So you almost essentially doubled your reporting. And if you don't get the right return on the investment, it could really eat away at was this a good purchase or not.
Well, people might be calling you for this, eh?
I hope so.
All right,
I'd be happy to help.
Okay, we'll put your number and information below this.
Of course.
Awesome. Thank you, Jordan.
Thank you.
All right.